Hi, welcome to this channel. I want you to be rich. Today we're going to touch on a very interesting topic and a very important one, the S&P 500. As you all have heard, a lot of retail investor has been asked to invest in the S&P 500 index fund. So before you invest in the index fund that tracks the S&P 500, you got to know what is the S&P 500. Hi, my name is Lee. I teach people about money, investing, and personal finance. So the S&P 500, it's Standard & Poor's 500 companies in the United States. It was started in, believe it or not, 1923 by the Poor's Publishing and Standard Statistics. And it is now a major indicator. S&P 500 is a proxy for U.S. equity, and it's the only economic index that's used by the Conference Board leading economic index, which is the government way of measuring economic activity in the United States. It has 80% of the market value. So why people invest in the S&P 500 index fund that tracks the index is because it covers 80% of all the shares on your stock exchange in the United States. So and some of the companies that you might be very familiar with that you use, I'm using an iPhone right now. I buy from Amazon, and I just Google some of my information. I open my Windows, it's Microsoft. I go to my social media, Facebook, and there you have it. Apple, Amazon, Alphabet, Google, Microsoft, Facebook, they own more than 50% of the index. So meaning that 50% of the index that tracks how the economy is doing is from these companies. And why is the S&P 500 so much the talk in town is because unlike the other two index that's very famous, that's the Dow Jones Industrial Average, and you have your NASDAQ composite, is that the S&P 500 is very big. It's 80% of the equity market, and it tracks 11 industry, and these other 11 industry that I'm going to go through. So the 11 sectors that the S&P 500 tracks are, number one, no surprise, technology. So we have Apple, Amazon, Google, and they don't used to be the heavyweight in S&P 500. The market capitalization is not as heavy. It used to be ExxonMobil, Johnson & Johnson, a lot more industrial companies. But as you know, in the last few years, technology has taken over and they become very large market cap. And now it also comes to the way to explain S&P 500, how it's calculated, is that it takes market capitalization multiplied by number of shares. So if my share is $2 each and I have 10 shares, basically I take $2 multiplied by 10, I get $20, and that is my market capitalization. And if you're very confused about how it's calculated, just Google Finance. I put the link below for Berkshire Hathaway B, and you will see what is the market capitalization, what is PE ratio, and all that. And the second industry that they cover is healthcare, and you know healthcare is very big in the United States. And number 3 is consumer discretionaries. These are some of the companies. Number 4, you have communication. So when you're using your mobile services, Verizon, AT&T, yeah, they are making money, and it's on the S&P 500. Number 5 is financials. Bank of America, JP Morgan, they're all inside your financials. Number 6 is your industries. So whenever you take an aeroplane, it's most likely made by Boeing. Whenever you use a sticky tape or whatever, is made by 3M, and they are in your industries. And number 7, consumer staples. Guess what are the companies inside? Whenever you use your shampoo, it's by Procter & Gamble, P&G. P&G is inside consumer staples because you have to use it every day. And or toothpaste, or when you walk into Costco is inside consumer staples. So whenever you buy from Costco and P&G, remember they are tracking S&P 500. And then number 8 is just utilities. So whenever you have electricity bills or water bills or gas bills, yeah, they are in your utilities. And number 9 is real estate. Number 10 is energy, gas, raw gas. And number 11 is material like steel, S&P 500. So how does the S&P 500 select companies to get in? There are 5 criteria that I can think of. That is, number 1, very important, you have to be a United States company. Your headquarters got to be in United States. It is non-negotiable. And number 2, you got to be a fairly large company. So you got to have at least $12 billion of market capitalization. $12 billion. So you can't just be a startup and be included inside. $12 billion. And number 3, you got to have at least 10% of your shares floated. Number 4, you have to have positive earnings. Number 5, you need to be at least listed for 12 months. So, I don't know, 12 months seems pretty short, but maybe you're a very, very successful company and listed for 12 months and you get inside. So, these are the 5 criteria to get into the S&P 500, and then they take your number of shares that you have, multiply by the share price, so you get your market capitalization. So a company like Amazon that has a huge market capitalization, or Apple, would have a much, much larger weight than, say, a smaller company. So I don't know if you have seen this, but Warren Buffett famously said in an interview with CNBC that if you don't really understand or is an active investor, the best way is to find a low-cost S&P 500 index fund to invest, because over time, it's going to beat hedge fund and growth funds. And over the past 10 years, I think he made a bet and he won. So S&P 500 index fund, low-cost fund, actually did better. And some of these funds, say Vanguard S&P 500 fund, only takes in 0.3%. So you're paying like less than $500 for $1 million of investment, because it's very passive, because basically the fund doesn't do anything except track the S&P 500. So if it's so good, what is the negative side of investing in an index fund that people don't talk about, because they are always hyping about index fund? Let me give you what is the not so nice side about investing in index fund. Number 1, you don't own the company. You are a unit holder in a fund that tracks the S&P 500. So you don't own Berkshire Hathaway, you don't own Amazon, you don't own Apple. And that is a huge problem, because you own a unit in the fund. What does that mean? You can't go to shareholder meeting. You can't vote out the CEO. You don't have direct involvement with the company. You own it through a fund. Number 2, you don't really know what the fund is investing. I mean, obviously they disclose what they're investing, but they take your money and they, do some jumbo up with it, and then they track it with the S&P 500. There is some financial statement, but it's not as transparent as, say, I own 2 shares in Berkshire Hathaway, or I own 5 shares in Amazon. It is really not like that. The fund has a whole performance metrics and how it actually calculates returns. So that makes it less transparent. And I'm always someone for transparency if you're more advanced or intermediate. So transparency is not really there. Number 3 is you get lower returns than if you have invested in stocks that are growth, like Amazon, Apple. If you have been investing in them since the start, you would definitely have done better than the S&P. But having said that, the S&P gives you lower risk because it doesn't have higher returns. It basically averages out everything. Average earnings means that you don't get the highs and you don't get the lows. So that is a compromise. And the part that's not so good about index fund that everyone knows is fees. If you go for S&P index fund, unless it's like a Vanguard or something, it still has a fees, and fees eats up your returns over time by a lot. And also because of a lot of these S&P index fund are invested with a lot of retailers, there can be a lot of panic and people dumping the fund, and the fund can go down versus go up, because you're not like Apple and Amazon, for example. They have huge institutional investors. So it's important to actually go into a investment knowing what is the percentage of institutional investor and what is the percentage of mom and dad retail investor. Why is it important? Because when there's a panic, mom and dad investor are going to panic a lot more. They're going to dump that unit shares or mutual funds or index fund a lot faster than institutional investors, and that affects the overall price. But it depends on what kind of fund you buy and how is it structured. So the structure of the fund is important. You have to read the contract. It's not as easy, let's just buy S&P 500 fund, index fund, and sleep on it. It's a little bit more complicated than that. And if you want to find out about funds, these are some of the companies that are very popular and have very low costs. I included a link below as well if you want to find out more. So what are the positives of S&P 500 index fund is that it's low cost. It's pretty passive. You don't need to be an expert on investment to know what is it. Overall, it has done very well. If you buy it more than 5 years, if you are a short-term investor, you buy and sell in 1 year, buy and sell in 3 years, buy and sell in 5 years. Even buying the fund, you can lose money. Because there are days that actually doesn't do very well. One interesting fact before I end the show is that the largest price S&P 500 company is Berkshire Hathaway. It's run by Warren Buffett and his team, including Charlie Munger and a team of experts that are taking over. And the share price of Berkshire Hathaway Class A share is 500,000 and above. I included the link below. Have a check. If you like this channel, please subscribe and like. I appreciate that because it helps with the algorithm and I can make more videos like that to help you. Thank you and have a nice day.